All of us are wearing blue shirts, so this must be this must be a finance conversation.
Finance uniform.
Finance uniform. What a creative field. But you know what? Finance is probably where you shouldn't be creative. This is where leave the creativity for the engineering
That's right.
side of the house.
That's right.
So Brian, welcome. Our new CFO. Can we edit in some applause? Yeah. So welcome. We did this with Carl. We're going to do some more of these kind of executive conversations. And so really we want to talk a little bit about you as a person, just your career, because you're the most senior finance person in the company now. So we just learn a little bit about you, and then a little bit about what's a company of this size and how do we deal with finance? What are the important things in finance? And then maybe the most broad topics are just what's happening in markets at this time time and stage. Peter, that's what's on my sheet. You got anything different?
Yeah. So Brian, let's start. Would love to hear more about your experience.
Sure. I mean, I like a lot of people who are drawn to applied. I grew up as an engineer. I was the son of an electrical engineer. I studied electrical engineering at Cornell. Worked for
Where'd you grow up again?
Tucson, Arizona.
Tucson. That's
Yeah. My dad was an IBM guy.
Yeah.
So he had his choice of going to Arizona or San Jose, and he said San Jose is too expensive, and so that's how we ended up in Tucson, Arizona.
All roads though lead to Silicon Valley.
That's right. That's right.
Yeah. So you're saying Cornell? Yeah.
That's right. So I studied electrical engineering at Cornell. Was really interested in signal processing, digital communications. Wanted to go to the best place that was happening. That was at Qualcomm. So I spent 6 years at Qualcomm doing embedded software, building white.
Wait, is this a head of engineering interview or anything? The finance guy?
And Qualcomm does a lot of advanced stuff.
Yeah, for sure.
That's right.
Brief aside, what was your favorite Qualcomm product?
My favorite Qualcomm product was the very first wideband CDMA chip, because that was the entry into the market.
Verizon was through.
No, Verizon was CDMA 2000.
Oh,
so
okay.
wideband CDMA, not to nerd out, maybe Peter and I can have a separate conversation
Yeah.
around this. But no, this was like AT&T, and this was like the evolution from GSM.
Okay, got it. That's what I needed to know. Yes, and so you were at Qualcomm for.
About 6 years.
Okay, got
Yeah.
it. And then how did you? What made you go into finance?
Yeah, so it's funny. I had 4 patents while I was at Qualcomm, and Qualcomm has a really large IP portfolio, and as a result, they're and a pretty strong patent business. So it's not unusual for there to be patent litigation. I got brought in because one of our patents was the subject of a case. And I was brought in as the engineer to go talk to lawyers about it, and the lawyers were like, "Wow, you can explain this stuff in simple terms that non-engineers can
Why
understand."
don't you go into law? You could have been RF. You could have been head of legal.
We'll see. We'll see.
Yeah. Maybe that's the third act. Yeah.
Third act. But yeah, no. So the lawyers found me, and they said, "Wow, you can explain this stuff. Can you help us with this other case?" And I said, "No, it's not my patent." They're like, "Yeah, but can you help out?"
Yeah.
And so that started getting me involved in some of the more business-facing aspects of the business, and that's got what really kind of lit my interest into. Well, shoot, like we're looking at all these things that we build, but we also look at things to buy. And why would we do that? As an engineer, you're wired to like, oh, we have a problem, go build the thing to solve the problem. And that was like the light bulb that went off that, oh, companies actually make inorganic growth investments.
Yeah.
And so that's what led me to go to business school.
And then you go to business school, and then you fully switch over to finance. You go to Goldman,
Right.
and
And you went to MIT Business School, right?
Yeah, that's right. MIT
I
Sloan.
won't hold that against you. That's okay.
I know, we're rivals from across
I've been right
from across Cambridge. Okay. Got to throw the HBS jab in there.
We're in the same town, both Boston-based B schools. Listen, I have few things in my life which I can be really proud of, and for a immigrant kid going to Harvard is like a big deal. So just let me just hold on to.
But you know what's funny? One of the professors at MIT Sloan used to say, HBS guys have better haircuts, but we're smarter.
Yeah, that's
I don't know.
well. Let's just edit that out. So let's talk about Goldman. So you were at Goldman for a real career, 12, 13 years.
Yeah.
So in the B school universe, you really climbed that that difficult ladder of what did you do there? What was that time like? What did you learn? Yeah.
Yeah. Well, if you look at the calendar of when I joined in 2009. That means got my job offer in 2008, which was not a fantastic time to be searching for a job in banking, let alone
Yeah.
finance more broadly. But I was lucky enough to get an offer. Uh, I went to the San Francisco tech practice at Goldman because that's where all the most interesting deals were happening from my perspective. And what the fascinating thing that happened in 2009 was the great financial crisis had happened. Uh, it was still a sort of choppy time in the markets. And so a lot of the buyers who would be normally reliant on credit or debt to fund acquisitions weren't in that position anymore. But all these tech companies that my corporate finance professors at MIT would say, oh, these guys don't know how to manage their balance sheet, they have too much cash. They were then in a position to really be acquisitive because no one else who was reliant on debt could compete. And so it was a lot of trial by fire of a lot of M&A activity, this flurry starting in sort of 2010 through really the next, call it, few years.
Yeah,
There's
that
a
was,
lot
I
of
mean, we sold our company to Google at the time. There was
Exactly.
a lot of M&A happening.
HP was super active at that time. There were a number of really big deals happening in and around sort of security and enterprise. And so I was lucky enough to kind of work in a group where I had a lot of exposure to a lot of deals. I covered over the course of my time at Goldman, I covered everything from small startups that were working out of like an incubator house, all the way up to I spent time with companies like Apple and Facebook, Tesla. Twitter is one of the companies I took public. The last company I took public on the way out was Coinbase. So I was the first person within investment banking to be covering crypto, and that was, as you can imagine, a pretty challenging thing to do. In 2013, 2014, it was not obvious that this was
Yeah.
something that we should be spending time on, and so I spent a lot of time within the firm trying to get folks.
What do you, for folks who are in finance today, who are maybe at places like Goldman
Yeah.
or similar institutions, what do you think they don't get about tech? And because now you've been on the inside, you were at another A16Z growth company where you were CFO and COO, and now you're CFO here. What do you think those folks don't get? Maybe the bankers specifically.
I think the hardest thing if you're coming at things from just a purely financial perspective, I think the decisions that are the long-term right decision as a technology business operator are not so clear. The simplest thing would be if you were looking at a project as an engineer and saying, well, we could invest a certain amount of bandwidth to kind of build things from a scalable platform perspective, but it might cost more today, but is ultimately long-term the right thing as the business scales. You would say that's the right answer as an engineer. But if you were trying to understand how decisions get made from a purely financial perspective, you might say, well, the ROI isn't there.
Yeah.
And so I think having a background in engineering and understanding what it takes to bring a product to market, and some of the technical decisions that you make in the short term that accrue over the longer term, that's like a perspective that I have that a lot of people don't. And then when you get into hard tech businesses, Qualcomm actually ended up becoming one of my clients at Goldman as well. For businesses where the technology is not so consumer facing, it's actually really hard to understand what it does unless you really get deep into the technology. And as somebody with an engineering background, you can really unpack that a lot easier.
Yeah, it's interesting. I think like really hard tech companies, the advantage you have is if you solve problems that are complex, you own the market.
Correct.
The disadvantage is you have to now communicate the complexity of the problem that you solved, and that it isn't just something that someone can pick up and learn. I mean, you take our business with engineering tools. I mean, some of those tools, I mean, we're talking about 100 engineers working for multiple years.
Right.
Those are not trivial to build.
Right.
But from somebody who's non-technical, they only see this very thin layer of pixels, and
right.
they're like, oh well, the simulator can't be that hard to build. And I think the best, at least from my perspective, the best finance folks, they give some respect to that.
Right.
The thing they don't understand, rather than not.
Oh, for sure. I mean, I still remember the days of being embedded software engineer, spending hours and hours to debug code. And the solution was literally one character. And so if you were looking at it from that perspective, you're like, well, that was super easy, except for the hundreds and hundreds of hours it took to find that one character that was wrong in the code base. So,
what just changing gears here to let's say the finance team at this stage and the role at this stage. I'm sure everyone who interviews for this job, to work on your team in the next years will watch this.
Yeah.
So first is like, from a more of a leadership perspective, before we talk about technicals, what makes a good finance team? What makes it operate effectively? And what are the goals at this stage? Kind of a late stage company with,
Yep.
a fairly significant operation.
Yeah, I think about the best finance orgs of any company that I've ever worked with, either as an operator or as a banker advising the company. The best finance teams are enablers for the business, right? So they are thinking about how do we allocate capital to the place that's going to enable the business to grow the fastest or drive the most value, and the contrary example of that is if you're just really kind of a toll taker or the derogatory term of bean counting, right? If you're just there to record the results of the business, but you're not really driving value or making any insights to drive,
Strategic, yeah.
to derive strategic insights, that's not a super high value add finance org, in my opinion. So, the way I think about it and the way I've managed finance teams here and at my prior company is really to focus on what are the things that what are the pieces of value we can drive to the business to enable the business to do what we want it to do, and also make smarter decisions about how we allocate our resources.
In terms of more on the technical side of leading a finance organization, what's different about this stage versus folks who are watching and they're running a Series A company,
Right.
or they're part of a finance team in a Series A company,
Yeah.
and then the other side of being a public company, and what's particular that you think about now?
Yeah, it's a really great thing I have a lot of empathy for people who invest capital in businesses, and empathy not in the sense of like I know what I think about what it is that their objectives are and what their risk is, or what their risk profile is, right? If you're investing capital in a Series A company, you have inherently a different risk profile than somebody who's investing in a growth stage company. And then similarly, when you look at public companies, there is a spectrum, and you actually have investors who fit into different call it style categories. And so as a company that is in our stage, we have a different profile than like a seed stage business or a Series A business. And so when we think about deploying capital and the return that has to be generated on that capital, it looks different than a Series A, and also and inherently the risk adjusted return on that capital.
Do you think the company's strategy drives the finance, or the other way around, in the sense of you have companies in the Bay Area that are consuming tons of capital, and then you have other companies that are more prudent. Yeah, like even when we think about where should we allocate resources, what's the right way to think about that? What comes first? Is it we're going to spend the money, or this particular market desires or wants us to spend money, or requires us to spend money?
That's an interesting question. I think you can't ignore the capital environment around you. There are businesses that literally could not have been brought to be if capital was not as readily available, right? A lot of the multi-sided marketplace businesses where there's a lot of capital required to stand up markets, the ride-sharing businesses, for example, you had to actually deploy a lot of capital in every single city. And inherently, those were loss-making dollars for the near term, and ultimately the longer term, as you get scale, they became profitable. Those are only possible if capital is available at scale. And what we all saw in like 2022, when interest rates went up drastically, the risk profile of capital changed dramatically. The desire for return to be sooner changed dramatically, and that ultimately impacted how operators of businesses like ours had to think about how they deploy capital. So, I think you can't pretend like that doesn't exist.
And right now, there's so much money being poured into model training at a lot of companies, ours included.
Right.
And from the finance perspective, how do you think about that in terms of is that a good investment or not?
That is the probably the $1 billion question. I think we've seen
15 billion, I think, is really that's a 15 billion question, to be more precise.
Yeah.
Yes, yeah.
Yeah. So I would say I look at our allocation of capital into things that ultimately drive product, and we look at what is the likelihood, or there's risk in every investment we make, but if we believe there's a real commercial opportunity on the other side of that investment, and we have conviction around that, that's when we we press. And I think the challenge that we've seen in other businesses where they're deploying a lot of capital in training or in data, they haven't actually necessarily proved that there's a business model there. Whereas, you've said this many times, uh, uh, we actually sort of made sure this was a good business before we did it, right? Like we actually sell products, and so that's kind of, I think, part and parcel of how you think about deploying capital. We have to believe that there's a commercial benefit to doing it, and then we can scale that based on our risk tolerance.
Before we go into broad market topics, advice you have for other, upcoming CFOs, folks who are interested in the industry, or maybe even engineers in our company who are
Yeah.
like, I might go to like HBS or MIT or wherever to, make the shift.
Yeah.
Just a broad career advice for folks like, with similar to your backgrounds.
Yeah. I look at the finance function, and actually, this goes back to one of the things I said to you when I was debating taking this job. Is I said, the way I think about this job is my job is your job as a CEO, except I look at the world through the lens of finance. But the aperture of what I do and the aperture of like the impact I want to have on the company is that broad.
Yeah.
If I do my job right. And so my advice to folks who are in finance and want to transition to a more an operating role or a leadership role is don't be so narrow about where you think your ability to influence outcomes is, because ultimately, if you want to be the owner of the business and act like an owner of the business, if you act that way, you ultimately will be.
Yeah. Okay. Let's talk about markets more broadly. There is a huge kind of let's say, spectrum of the way that AI companies are thought of and the way that they position themselves. How do you think the next years are going to kind of unwind for on one end you have the companies that are doing foundation models, and on the other end you have companies that are very specific applications, whether it's autonomy
Hmm.
or maybe like LLMs for legal or something like this.
Hmm.
Do you see more money coming into space? Do you see less money coming? So you've worked on both sides of the house, operating and on banking.
Yeah.
And what's the downstream impact for everybody who's broadly speaking in AI?
Yeah, I think what's fascinating about AI is that there are so many layers of value capture, and what is ultimately defensible and unique is, I think, not. I don't think it's as respected in what we're seeing playing out right now, right? Obviously, at the hardware and enablement layer, NVIDIA's captured a ton of value because that is like requisite to be able to do anything. But you look at sort of the foundational models and what has happened, whether Meta's tactics versus proprietary models, like that. All of those things can change the landscape pretty dramatically. And then if you don't have a defensible position on the other side of all the capital you're investing to train those models or whatever you happen to be building, that's where you can very quickly have the sort of the ground move out of underneath you.
Do you think there'll continue to be just lots of investments happening in this space over the next 5 years?
I do think so, just because everyone kind of looks back and refers to sort of these big technology shifts and the
Yeah.
big technology shifts that have happened, whether it's the PC era, mobile, internet, all of that stuff. I think those big themes that drive massive waves of capital investment, and because you have so much capital coming in after those waves, you're inherently going to have money go toward things that maybe are lower return, let's say. But there are going to be massive winners as well. I mean, I think if you go back to like the dot-com era, right, there were a lot of businesses that were funded that no longer exist. But out of that era where so much capital, there were massive, massive businesses that got created.
Yeah,
And so
yeah.
I think that's probably what we're going to see.
Do you think there's been a shift? You take that era,
Hmm.
Amazon goes public when the company is like 400 million in valuation. So
Right.
you have companies that are staying private for a long, long time.
Right.
Do you think that the large amount of capital is only growing? Our own managers, our own investors manage just much, much more money.
Right.
Do you think that's going to change anytime soon? Or are we going to continue to see a larger percentage of the total, let's say, market cap of tech being private versus public?
I do think you're going to see more businesses wait to get larger before they go out. And again, this goes back to how, like, having an appreciation or empathy for how investors who are deploying capital think about things. You have to be large enough in scale that they can actually deploy a meaningful amount of capital. Otherwise, I mean, the work is, I don't want to call it the same, but for a smaller business versus a larger business, if you are an investor, you still have to do a lot of work. And so if that means you can only deploy $100 million instead of $1 billion, you're going to do the thing that's more worth your time. And so I think inherently what happens is you're going to see more companies like us become larger while private. And then if it makes sense to tap the public markets, you'll do so when you're larger. And I think we're seeing that play out with a lot of the companies that are, entering the markets today.
So in deep tech markets, right, it's not as straightforward as a SaaS business where the business grows gradually every single day because of new subscribers coming on. There is some lumpiness, there is some customer concentration.
Right.
How does that affect the attractiveness of a company to the broader market?
So I think if you were to just look at it from that lens, you would say, well, there's less predictability of revenue because of the lumpiness. There's just that one factor. You would say, I will discount that because of that risk or because of that lack of predictability. But I think when investors are going to look at these businesses and us included, the potential outcome of the prize on the other side of it, which is disproportionately large, will also factor in. And that's really what's going to sort of drive the investment thesis, right? Because if they're right, it could be massive. And that's I think really the theme that people are going to focus on.
Yeah, one of the interesting things like you're seeing in this like post SaaS era, and as we enter this kind of, let's say, for lack of a better word, post transformer AI era, is I think retail investors specifically are willing to go on for the ride for something that's going to take some time to build,
Right.
rather than just saying, you're going to call your quarterlies and you're not going to call your quarterlies. And that's just fundamentally different. Some people I think pejoratively talk about some of the stuff as like, oh, these are meme stocks,
Yeah.
or these are just like heavily interested about retail investors. And I think the book that could be written about this, 10 years, 15 years in the future is like, those were actually the durable companies because they're building stuff that actually took time to build.
Right.
And actually the fact that you could call the quarter, to some basis points for 6 years in a row doesn't matter when that company actually takes a nosedive because it just didn't have a sustainable technical advantage.
Right.
And I think part of that is investors, a bunch of investors are on the institutions that are just not technical.
Right.
To them, they see three companies and they all say models and they all therefore must all be similar enough, but
Right.
they all might say autonomy and they're all like interchangeable. It's like actually these are vastly different.
Right.
So I think there's a part of it. When you look at Qualcomm, companies have the hard tech companies have concentrated
Right.
positions. Yeah.
Yeah. Actually, as you were talking through that, it made me think of, I was lucky enough to work with Tesla through a lot of fundraising, starting with their IPO. And a lot of people may not remember, but we took them public with no product revenue at the time. They had stopped selling the Roadster. And then they went from shipping Model S to hopefully shipping Model 3. And at the time, there was this debate amongst, I think, the investor community of like, well, what is this thing worth? And you had the company setting these production and vehicle targets that they missed for several quarters. But the investors who had conviction in the company and actually stayed in and ultimately made a lot of money, institutional investors, they didn't look at the volatility of the quarter or any of the stuff in the near term. And the way I kind of framed it to folks when they would ask me about it is I said, well, look, you could be wrong. Let's say you were trying to forecast like a tsunami hitting the coastline. You could be wrong by a few days. You could be wrong by a couple months. But ultimately, it doesn't really matter because when the tsunami actually comes and hits, the coastline is changed forever. And I think that's how like people who really understood what the opportunity was looked at that business.
Yeah. So, as we wrap up here, you've been at the company for a little bit now. Recommendations or advice that you have, based on what you know about markets and what you know about our products and kind of the culture of the company?
Yeah, like we're fortunate that you guys have built a fantastic business.
Oh, wow.
Great technology.
That's a whole team. Yeah.
But my advice would be we have to continue to be aggressive. We have to look for opportunities and deploy capital so that we can bring leading technology to market and continue to drive massive value for our customers. And I think if we do that and we push and deploy capital in the right places to do that, I think we'll continue to be successful, and our customers will be too.
Cool. Well, welcome to the company and to the role, and I'm sure you're hiring, so we should always give that apply.co/careers plug. Cool. Thanks, Brad.
Thank you.
All right.